Hey, welcome. Today, we are going to pull back the curtain on something that has a massive impact on all of us, whether we know it or not. We're talking about how a small group of people in Washington, D.C. can pull levers that affect your bank account, your loans, and yeah, even the entire stock market. So let's get right into it. So let me just ask you this right out of the gate. Who do you think is really behind the wheel of the U.S. economy? Is it the president? Maybe some tech billionaire? Well, the real answer might actually surprise you, and it is the key to, well, everything we're about to talk about. All right, here's our roadmap. First, we're going to meet the economy's conductor. Then, we'll look at its most powerful tool. After that, we'll see how its decisions ripple all the way down to you. And finally, we'll figure out why Wall Street is so completely obsessed with every word this conductor says. Okay, let's meet our main character, the Federal Reserve. You've probably heard it called the Fed. It's the central bank of the United States, and it's been around since way back in 1913. Its whole job is basically to keep the country's financial engine running smoothly. But the big question is, how? Well, Congress gave the Fed what's known as a dual mandate. That means it has two main jobs. Job number one, maximum employment. They want pretty much everyone who wants a job to be able to get one. Job number two, price stability. They need to keep inflation from going crazy, aiming for this kind of sweet spot of around 2%. Now here's the catch. These two goals are constantly in a tug of war with each other. And this is the best way to think about that balancing act. Imagine the Fed is driving a car, and that car is the US economy. Their job is to keep it moving at a nice, steady speed. If they step on the gas too hard, the engine overheats. That's high inflation where prices spiral out of control. But if they slam on the brakes or just go too slow, the car stalls out, and that's a recession. It's this incredibly delicate dance. So how does the Fed actually control the speed of this economic car? What's the gas pedal and what's the brake? Well, let's look at its main lever, its single most powerful tool. It all comes down to something called the federal funds rate. Now, I know that sounds super technical, but stick with me. The idea is actually pretty simple. It's the interest rate that banks charge each other for these super short-term overnight loans. You and I, we never see this rate directly, but it's the bedrock. It's the absolute foundation that almost every other interest rate, your mortgage, your credit card, everything is built on top of. And who actually makes these huge decisions? It's this group right here, the Federal Open Market Committee, or the FOMC for short. It's made up of 12 members, and they get together 8 times a year. They look at all the economic data, they argue, they debate, and then they vote on whether to hit the gas, tap the brakes, or just cruise. In other words, to raise, lower, or just keep that federal funds rate right where it is. If you remember one thing, remember this. This is the absolute best analogy for it. Think of the federal funds rate as the wholesale price of money. The Fed sets that base cost. And then all the banks we use, they add their markup, their profit, to create the retail price of money. And that's the interest rate we pay on our car loans, our mortgages, and everything else. Okay, so a committee in D.C. changes some rate that only banks use. So what? How in the world does that actually end up affecting you? Well, let's trace the journey of that decision, that ripple all the way into your wallet. It's a shockingly fast chain reaction. First, the Fed makes its announcement. Then, almost instantly, I'm talking within hours, the big banks adjust what they call their prime rate, which is the rate they give their best customers. And from there, boom, the ripple hits you, and the rates on your own loans and credit cards start to change. So let's say the Fed cuts rates. What does that actually mean? Well, that credit card you have with a variable rate, the interest you pay could get cheaper in just a month or two. And while things like mortgages and auto loans aren't directly tied, they almost always follow the trend, making it cheaper to buy a house or a new car. And for businesses, it makes it easier to borrow, to expand, and to hire more people. But, and this is a really big but, there's a whole other side to this coin. It's fantastic news for people who borrow money, but what if you're a saver? When the Fed cuts rates, the interest you earn in your savings account or on a CD, that goes down too. Your hard-earned savings just don't grow as quickly. And that brings us to a really crucial point. Every single decision the Fed makes creates winners and losers. When rates go down, borrowers win. Their costs go down, they have more money in their pocket, but savers lose out. People on a fixed income, retirees, anyone trying to build a nest egg, their interest income just dries up. It's a fundamental trade-off they have to wrestle with every single time. All right, let's zoom out a bit. We've talked about your personal finances, but what about the bigger picture? If you ever turn on financial news, you know they are completely, totally obsessed with the Fed. Why is that? Let's connect the dots between what the Fed does and the stock market. I mean, it's a fair question, right? How can changing the wholesale price of money make a company's stock suddenly shoot up or fall down? Well, it turns out there are a couple of really powerful reasons why. First, let's talk about the simple stuff. A lot of companies have debt, right? When interest rates fall, their loan payments get smaller. That means their costs go down, which means their profits go up. It's really that simple. At the same time, we just saw that lower rates mean people like us have more money to spend, and that means more sales for those same companies. So you've got lower costs and higher sales. That's a pretty powerful recipe for a rising stock market. But there is an even deeper, more fundamental reason this happens. Let's try a little thought experiment. Imagine someone makes you a rock-solid promise. They will give you $100, but you have to wait 5 years to get it. Now, how much is that promise worth to you today? It's not $100, right? It's worth less. Because you could take, say, $80 today, put it in the bank, and let it grow to $100 over those 5 years. Well, the interest rate is what determines that discount on future money. Now, just apply that exact same logic to a company's stock. A stock's price is really just the market's best guess of what all of its future profits are worth in today's dollars. When the Fed raises interest rates, that discount gets bigger. All those future profits are suddenly worth less today, and the stock price tends to fall. But when the Fed cuts rates, the discount gets smaller. Those exact same future profits are suddenly worth more today, and the stock price goes up. So let's wrap this all up. Next time you hear the news talking about the Fed, here are the 4 things to remember. 1, the Fed is constantly performing a balancing act between fighting inflation and fighting unemployment. 2, rate cuts are like a catalyst, hitting the gas on the economy. 3, rate hikes are the brakes, meant to cool things down. And finally, number 4, every single move they make creates a different set of winners and losers. Which brings us to one last question to leave you with. We've called the Fed a driver, a conductor, all things that imply they are in complete control. But are they really? Or is the economy more like a wild, unpredictable orchestra, and the Fed is just doing its absolute best to react and try to keep the music from completely falling apart? It's something to think about. Thanks so much for joining me on this explainer.